Hello, I'm Kevin Gallagher, Managing Director and CEO of Santos. I'd like to take you through an overview of our half-year results, which were released today. Starting with safety, and I am pleased to say that we maintained our excellent safety record with lost time injuries at 9-year lows. We also set a new first half production record of 31.1 million barrels of oil equivalent, up 10% on the previous year. However, sustained low oil prices continue to challenge our business and have significantly impacted our financial results for the half. We reported a net loss of $1.1 billion, largely attributable to the GLNG impairment of $1.05 billion after tax. The non-cash impairment reflects changes in long-term operating assumptions. Excluding impairments and other one-off items, we recorded an underlying net loss of $5 million after tax for the half. In line with our previously announced dividend framework, which provides for the setting of dividends as a payout ratio of underlying earnings, the board has elected not to pay a dividend for the first half. I understand these results are disappointing for shareholders. However, it is important to note we have taken swift and decisive action in the first half to stabilise the business and increase operating cash flow. So let me tell you about some of the programmes we have put in place to deliver sustainable shareholder value. So far this year, strong progress has been made on driving costs out of the business. Capital expenditure is down 58% to $283 million. Production costs are down 15% to $8.80 per barrel of oil. We restructured the business, removing 253 positions and generating a sustainable cost saving of $35 million per annum. We have also identified $110 million in supply chain savings year to date, and drilling costs have reduced by 27% per well in the Cooper Basin and by 53% per well at GLNG. The result of our cost out programmes has seen our free cash flow break even reduced from $47 to $43.50 per barrel of oil, down $3.50 per barrel since the start of the year. Importantly, as a business, we were cash flow positive for the last 2 months of the half, and I'm pleased that this trend continued in July. We also reduced our net debt by $220 million in the first half. We've transitioned from a geographic to a centralised asset-based organisation, and as part of the new operating model, we have adopted a centralised portfolio management process that enables disciplined decision-making across our portfolio of assets. Our focus is on optimising our asset portfolio to deliver an asset mix that achieves our goal of being free cash flow break-even at an oil price of between $35 and $40 per barrel. We set ambitious cost targets for our key assets, and I have been extremely impressed at how our Cooper Basin and GLNG teams have embraced the challenge to safely and sustainably drive down costs. In the Cooper Basin, unit production costs are down 15% on the previous corresponding period, and drilling costs are down $2 million from 2014 to $5.3 million per well. The GLNG project has just shipped its 50th LNG cargo, following the near flawless startup of trains 1 and 2. Our aim now is to deliver value by establishing GLNG as the industry leader in low-cost onshore operations. On PNG, LNG operator ExxonMobil continues to deliver excellent operational results, shipping 214 cargoes since startup and delivering an annualised production rate of 7.7 million tonnes per annum. And finally, in Northern Australia, Bayu-Undan and Darwin LNG continue to be important assets for the company, with record production delivered last year and strong, reliable performance continuing throughout the excellent work of operator ConocoPhillips. There is still a long way to go on our journey to transform the business. Our priorities for the next 6 months are to maintain a disciplined approach to capital allocation, to continue to drive costs out of our business, and to look at options for optimising our asset portfolio in line with our core objective of delivering sustainable shareholder value. Thank you.